A middle-aged American professional named Daniel reviews his annual compensation statement and feels satisfied. The number is higher than last year. Yet when he opens his bank dashboard, the movement of money across months feels tight and uneven. Some months look fine. Others feel compressed. This tension between headline income and lived financial control sits at the center of how the United States financial system actually works today. The difference is not motivation or discipline. It is cash flow structure. Across SEC filings, Federal Reserve distributional accounts, and company earnings calls, a consistent pattern appears. Income has become an unstable signal for financial capacity, while cash flow behavior has become the dominant constraint. This shift is structural and measurable. Federal Reserve financial accounts of the United States show that household liabilities have increased in absolute terms, yet the more revealing detail is timing. Required outflows cluster monthly while inflows remain episodic. Earnings arrive bi-weekly or monthly. Outflows arrive daily, weekly, and monthly. This mismatch matters more than the size of the paycheck. In 10K filings from major employers, compensation packages increasingly include deferred components, restricted stock units, or performance-based bonuses. These inflate reported income but do not smooth household liquidity. SEC proxy statements show that variable compensation now represents a larger share of total pay for professional and managerial roles compared to the early 2010s. Cash flow becomes uneven by design. The Bureau of Labor Statistics confirms that median weekly earnings have risen over the last decade. Yet the Survey of Consumer Finances shows that transaction-level balances remain thin for a large portion of households earning above median income. The gap is not explained by spending habits alone. It reflects the sequencing of inflows and outflows. Cash flow matters because obligations are rigid while income timing is flexible. Rent, utilities, childcare, education payments, healthcare-related costs, and subscriptions draw on accounts on fixed schedules. Income does not adapt to these schedules. Liquidity absorbs the difference. Public company filings provide a useful analogy. Analysts do not evaluate firms on revenue alone. They focus on operating cash flow. A company can post strong revenue growth and still face distress if operating cash flow fails to cover recurring obligations. Households operate under the same logic. Consider disclosures from large retailers in their 10K statements. Many report healthy top-line growth while simultaneously emphasizing inventory turnover and working capital management. Revenue without conversion to cash creates strain. The same principle applies to individuals. Federal Reserve research on household financial resilience highlights that volatility in cash inflows correlates more strongly with missed payments than income level. This research uses anonymized transaction data to track month-to-month balance changes. The finding is consistent across income brackets. Cash flow is not about saving more or cutting expenses. It is about alignment. The alignment of income receipt dates, asset liquidity, and mandatory outflows. In SEC filings from gig economy platforms and contract-based employers, companies explicitly describe transferring income volatility to workers. Earnings depend on hours logged, demand cycles, and algorithmic assignment. The Federal Reserve Beige Book repeatedly notes wage growth alongside rising cost pressures that arrive unevenly. Certain costs spike seasonally. Others reset annually. Income generally does not resynchronize automatically. Daniel notices that his largest stress points occur not when total spending rises, but when multiple obligations cluster before his next pay date. This is a cash flow compression event. It happens regardless of annual income. Public data from the Consumer Financial Protection Bureau shows that overdraft and fee events cluster around timing mismatches rather than low income alone. Households with higher earnings still incur fees due to sequencing issues. Cash flow analysis treats money as movement rather than stock. Balance snapshots hide risk. Movement reveals it. Market data reinforces this view. Equity analysts evaluate free cash flow yield, not revenue growth alone. Credit analysts focus on debt service coverage ratios. These frameworks exist because cash pays bills. Earnings do not. For households, cash flow strategy means structuring where money sits, how quickly it becomes available, and how predictable outflows interact with inflows. This does not require leverage or interest-based tools. It requires design. One research-based approach appears in Federal Reserve papers on liquidity buffers. Liquidity buffers refer to accessible funds that sit outside daily transaction accounts, but remain available within days. The research shows that households with even modest buffers experience fewer disruptions even when income remains constant. Another insight comes from SEC filings of subscription-based businesses. These firms invest heavily in billing cadence optimization. Monthly billing smooths cash inflow. Annual billing creates lumpiness. Companies choose based on cash needs. Individuals can apply the same logic to how they receive and allocate income. Cash flow awareness also reframes career decisions. BLS data shows that two roles with similar annual pay can have vastly different pay frequency and volatility. A role with predictable bi-weekly pay produces different cash flow resilience than one with quarterly bonuses. This is not about avoiding ambition. It is about understanding how money moves through time. Daniel begins mapping his inflows and outflows on a calendar rather than a budget spreadsheet. Patterns appear. Stress points repeat. This exercise reflects how corporations prepare cash flow statements rather than income statements. SEC guidance requires companies to disclose contractual obligations and liquidity risks. Individuals rarely perform the equivalent. Yet the logic transfers directly. Cash flow matters more than income because control depends on timing, not totals. Once cash flow becomes the focus, strategy shifts from accumulation narratives to operational design. Research from U.S. primary sources provides several actionable frameworks that remain ethical and monetization safe. The first framework is inflow segmentation. Federal Reserve transaction studies show that when all income lands in a single account, volatility increases. Segmentation means directing different income streams into purpose-specific accounts immediately upon receipt. This mirrors corporate cash management where operating cash, payroll cash, and reserve cash remain distinct. SEC filings from large firms reveal that companies maintain separate accounts for operating liquidity and strategic reserves. The goal is not higher return, the goal is continuity. For individuals, segmentation reduces accidental depletion of funds needed for near-term obligations. It also improves visibility. Cash meant for obligations remains untouched by discretionary movement. The second framework is cadence matching. This concept appears in Federal Reserve research on payment systems. Cadence matching means aligning inflow frequency with outflow frequency as closely as possible. When pay arrives monthly but obligations draw weekly, mismatch risk rises. Some employers offer flexible pay distribution options. BLS employer benefit surveys document this trend. Where available, choosing a cadence that mirrors obligations reduces compression events. The third framework is liquidity tiering. Federal Reserve liquidity research distinguishes between transaction liquidity and contingent liquidity. Transaction liquidity handles daily needs. Contingent liquidity covers irregular but predictable obligations. Tiering means assigning dollars to tiers based on timing rather than purpose labels. This avoids forced liquidation of assets at inconvenient times. SEC filings from investment firms highlight the risk of asset illiquidity during stress. Individuals face the same risk when funds sit in vehicles that require time to access. The fourth framework is obligation smoothing. Public utilities and service providers disclose revenue smoothing practices in their filings. Level billing reduces revenue volatility. Households can apply similar smoothing where providers allow it. The objective is not lower cost, it is timing stability. Research from the CFPB shows that households using smoothing options experience fewer late events even when total cost remains unchanged. The fifth framework involves income volatility buffers that do not rely on interest-based instruments. Federal Reserve papers describe non-yield-based buffers that prioritize access over return. These buffers sit outside daily use, but remain reachable within a short window. This approach avoids reliance on leverage while preserving liquidity. Case studies from SEC filings of logistics companies provide a useful analogy. These firms maintain cash reserves even when capital expenditures rise. They prioritize operational continuity. Daniel implements tiering and cadence matching. His annual income remains unchanged. His stress profile changes materially. Months stabilize. Decision-making improves. This outcome aligns with Federal Reserve findings that reduced volatility, improves perceived financial control, independent of income level. Cash flow also influences investment behavior. SEC disclosures show that forced selling often occurs due to liquidity needs rather than valuation judgment. Individuals experience similar pressure when cash flow is misaligned. By stabilizing cash flow, investors reduce the likelihood of untimely asset sales. This improves long-term outcomes without chasing returns. Market data from brokerage disclosures indicates that accounts with stable funding schedules trade less reactively. Stability supports discipline. The narrative around income often obscures these mechanics. Income is a static number. Cash flow is a system. Federal Reserve distributional accounts show that households across income deciles experience volatility. The difference lies in system design, rather than earning power alone. Cash flow strategy does not require prediction. It requires observation and alignment. In SEC risk factor sections, companies repeatedly warn about liquidity risk even during profitable periods. They understand that profit does not pay obligations. Cash does. For intermediate investors, applying corporate cash logic at the household level offers an edge that remains under-discussed. It relies on structure, not speculation. Daniel no longer evaluates his financial health by annual income. He evaluates by smoothness, resilience, and optionality. This mirrors how professional analysts evaluate firms. Cash flow matters more than income because it governs behavior under real conditions.